Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome back. This is lesson 2 of the second edition of our Beginner's Corner Information Series, a tutorial on covered call writing. This lesson is titled Option Basics. If we're going to use a strategy, we have to know how to talk the talk. So let's start off with some definitions. Covered call writing, which is something we discussed in lesson 1, is two strategies in one. First, we buy a stock. Then we sell the right to buy our shares at a price that we determine, which is known as the strike price. In the preview example we gave in lesson 1, we bought the stock at 48 and agreed to sell it at 50. So in that case, the strike price was $50. And the contract expires at a certain date, known as the expiration date. I favor 1-month contracts. Now, option contracts generally expire on the third Friday of the month at 4 p.m. Eastern Time. They do not coincide with calendar months. So we have to be careful knowing when an options contract starts and when it ends. Now, when we sell that option, we are undertaking an obligation, and for that, we are paid a cash premium. So when we go on our computer and buy the stock and then sell the option, that cash is generated into our brokerage account within seconds. And that cash premium is something that is known as the option premium. All right, what exactly is an option? Well, it's a contract. It's a contract that gives the buyer the right to buy or sell 100 shares of stock. So one options contract equals 100 shares. Now, the price that the stock can be bought or sold is known as the strike price, and the contract expires on the third Friday of the month. Weekly options will expire every week at 4 p.m. on Friday, but we favor monthly options. Now, a call option, which is what we're dealing with as it relates to covered call option, gives the buyer of the option the right to buy 100 shares of stock at the strike price. Keep in mind that we are on the sell side of the options, so we are selling the right to buy our shares from us. Put option is the opposite of a call option. It gives the buyer of that option the right to sell their shares at the strike price by the expiration date. But we're not dealing with put options in this particular tutorial. We do have a put selling tutorial on our website, but for right now, we're going to focus like a laser on covered call writing. So we're dealing only with call options. Now, the next 4 definitions relate to the option strike price. Remember, that's the price we're agreeing to sell our shares for as it relates to the current market value of the stock. And we have 4 definitions. 2 of them are very similar. Let's start with at the money. At the money is where the strike price, the price we're agreeing to sell our shares for, is the same as the market value of the stock. So, for example, if a stock is trading at 30 and we agree to sell the $30 call option, that strike price is said to be at the money. Now, closely related to that is near the money. Near the money is where the strike price is very close but not precisely the same as the current market value of the stock. So if the stock is trading at, let's say, $29.96 and we sold the $30 call option, technically that $30 call option is higher than the current market value of the stock, but it's so close that investors will refer to this as near the money, almost the same thing as at the money. The trickiest one of these 4 is the in the money strike, and that's where we're agreeing to sell our shares for a price lower than current market value. An example would be we buy a stock at 56 and agree to sell it for 50. Well, why would we do that? And the answer is the premium that we're going to generate when we sell that option is going to compensate us for the $6 we're going to lose on the sale of the stock, plus a little bit more. And that little bit more is what represents our initial profit, not the entire premium. So we're going to be breaking this down for you, and we're going to be showing you lots of examples with the Elman calculator, and all this will become second nature to you by the time you're done with this tutorial. The fourth definition of the option strike price as it relates to the current market value of the stock is out of the money. This is by far the most popular of all the strike prices, where it's higher than current market value. And that's the one that I used in the preview example. If you recall, we bought the stock at 48 and agreed to sell it for 50. Now, the reason it's so popular is that we can generate two income streams with the same stock, with the same cash investment in the same month. One from the sale of the option, and the second from share appreciation from current market value, in this case 48, up to the out-of-the-money strike price, in this case 50. And that's why out-of-the-money strikes are the most popular. But they're not always the correct strike to use, and that will be addressed later on in the tutorial. Finally, we have two more definitions here. The option value, the entire premium as it relates to the stock price. So the formula is a premium consists of intrinsic value plus time value. But intrinsic value applies only to in-the-money strikes. The example I gave on the previous slide was we bought the stock at 56 and sold the $50 call option, $6 under the current market value of the stock. Well, if we counted all of that as profit, we would be exaggerating our returns because we're going to be losing $6 on the sale of the stock. So if we generated an $8 premium when we sold that option, an $8 premium, by the way, would be a typical premium. So if we generated $8 on the sale of that option, of that $8, $6 we would lose on the sale of the stock. So what we want to do is deduct that 6 from the 8, giving us a $2 actual time value profit. So in this particular case, the intrinsic value is $6, and the time value, our actual profit, is $2. Now, for those of you that are concerned about doing the math, don't worry about it. The Elman calculator will do all this math for you, as you will see. Now, at the money strikes, buy a stock at 30 and agree to sell it for 30. And out of the money strikes, buy a stock at 48 and agree to sell it for 50. The premiums are all time value, all actual initial time value profit. The only strikes that have intrinsic value component to them are the in-the-money strikes, the ones lower than current market value. Now, if you don't grasp this right now, don't worry about it. Took me a long time to get this, but as we go through all the steps in the tutorial, it will become second nature to you, I promise you that. Well, what is an option chain? It's simply a list of quotes of option prices. If we buy a stock, we first look and see how much is that stock. Well, if we sell an option, we want to know how much cash we're going to generate when we sell that option. So we have to go to what's known as an option chain. Now, all brokers have option chains for every option that exists. There are also free sites. For example, finance.yahoo. You'll be seeing a screenshot of that coming up. And another free site is cboe.com. So usually what we do is we go to the site, we enter the ticker symbol, and then hit enter, and then look for an options link. So on this slide over here, you will see that we went to finance.yahoo. The stock is Alexion Pharmaceuticals. We put that ticker in here, and then we'll get to this page, and then we click the options link. By clicking the options link, we know that's going to take us to the option chain, and this is what an options chain looks like. Okay, so at the time that I made this screenshot, Alexion was trading at 144.08. So we're going to first show you the out of the money 150 strike over here, which generated a bid price of 320. You see the bid column up here? We sell at the bid, the lower. If we were to buy an option, we'd buy at the ask, the higher. But we're selling the options right now, so $3.20 is what we can generate minimum for selling that option, right? So next I'm going to show you the Elman calculator. And on the bottom row of the Elman calculator, you could see the figures that we just discussed. The Lexion was trading at 144.08. We generated 320, selling the 150 out of the money strike, higher than current market value. Now, when we sell an out of the money strike, we have upside potential. Price of Lexion can go from 144.08 up to 150. That's 592. So the initial return on the option, 320 divided by 144.08, is a 2.2% 1-month return. But if the price goes higher up to the strike price, we've generated another 4.1%, which means we have an opportunity in this 1 month for 6.3% 1-month return. I think you could start to see now the possibilities here with covered call writing. Now, sometimes we come across trades that are challenging. The price of the stock declines. Or sometimes it goes very high, way better than we expected. We should always be prepared with our exit strategies, which will be addressed in a lesson towards the end of this tutorial. But I just wanted to show you how the option selection works and how the Elman calculator works and can give you your returns. So let's summarize this particular lesson here, option basics. Options are contracts that give the holder the right to buy or sell 100 shares of stock. So they have the right to execute a future stock transaction, which may or may not be executed. Strike prices can be in the money, lower than current market value, at the money, equivalent to current market value, or out of the money, higher than current market value. Option premiums consist of intrinsic value plus time value, but only in the money strikes have an intrinsic value component to them. The example we gave for that was the stock trading at 56. We sold the 50 call for 8. So the intrinsic value was $6. The amount to strike was lower than current market value. And the actual time value profit then is 8 minus 6, or $2. And that concludes lesson 2. In lesson 3, we're going to discuss stock selection using fundamental and technical analysis. So, as always, I hope you enjoyed this lesson. This is Alan Elman, the Blue Collar Investor. Until we see you at lesson 3, take care, everybody.